Hello students, and welcome to Lesson 5 from Chapter 1 of FIA FA1. In today's lesson, we're going to dive into some essential business documents and processes. We'll cover sales orders, understanding how businesses document customer orders, purchase orders, how companies formally request goods or services, invoices, the official requests for payment, credit notes, used to adjust the amount due for returned goods, debit notes, requests to adjust amounts upwards or downwards on transactions. E-commerce, exploring how online shopping is transforming the way we buy and sell goods. By the end of this lesson, you'll have a solid understanding of how these documents and processes work together in real-world accounting and business operations. If you find this lecture helpful, please like the video and subscribe to the channel to stay updated with more lessons. Your support means a lot. And if you have any feedback or questions, feel free to drop them in the comments below. I'd love to hear from you and help with any clarifications you need. Thanks for joining today, and let's get started. Sales order. Description. A sales order is a document generated by a seller when a customer places an order to buy goods or services. This document serves as a contract that outlines exactly what the customer is ordering, the agreed-upon price, quantities, specifications, and delivery details. The sales order is crucial because it confirms the buyer's request and provides a clear record for the seller to fulfill the order accurately. This document ensures there is no confusion about the specifics of the sale for either party. Key components of a sales order. 1. Sales order number, a unique identifier for each sales order. 2. Customer information, includes the customer's name, contact details, and sometimes address for delivery. 3. Order date, the date the customer placed the order. 4. Order details, describes what the customer is buying, product name, model or SKU, quantity, and any options or customizations. 5. Pricing and taxes, lists the unit price, subtotal, any discounts, tax amounts, and total cost. 6. Delivery instructions, specific delivery date, location, and any special handling instructions. 7. Terms and conditions, may include payment terms, return policies, and warranties if applicable. Once the sales order is created, it acts as a binding agreement, meaning that the seller is responsible for providing the products or services as described. Purchase order. Description. A purchase order, PO, is a formal document created by a buyer, typically a business, to request goods or services from a supplier. The PO is sent to the supplier and acts as an official request for purchase, outlining all relevant details. It is legally binding, meaning the supplier is expected to deliver according to the terms specified in the purchase order. The PO helps the buyer manage their inventory and supplies efficiently, as it provides clarity on what, when, and how the supplier will deliver. Key components of a purchase order. Purchase order number, a unique identifier for tracking the purchase order. 2. Buyer's information, company name, address, and contact information. 3. Supplier information, vendor's name, address, and contact details. 4. Order date, the date the order was issued. 5. Item description and quantity, specifies what is being ordered with details like product name, model, or SKU, and quantity. 6. Pricing and payment terms, includes unit price, total amount, payment due date, or installment arrangements. 7. Delivery information, desired delivery date, shipping method, and location. 8. Terms and conditions, any additional agreements, such as return policies, warranties, or penalties for delayed delivery. A purchase order becomes a formal commitment, as the supplier is expected to fulfill the order exactly as detailed in the PO. The buyer can use the PO to verify that the delivered items match what was ordered. Sales order sets. Sales orders often come with multiple copies, called sales order sets. This helps the seller track the order at each stage, from confirming the order with the customer to making sure the warehouse prepares and delivers the goods. Let's go through each copy and its purpose. Sales order copy, locations and purposes. 1. Copy 1, sent to the customer, confirming the order. Purpose, This copy goes to the customer to confirm that their order has been received and the details are correct. Example: imagine a customer orders a custom heating system. Once they place the order, the seller sends them this copy to show that the order was received and includes details like the model, price, and expected delivery date. 2. Copy 2. Sent to the warehouse, arranging delivery. Purpose: the warehouse receives this copy to start preparing the goods and arrange for delivery based on the details provided. Example: if a customer orders a heating system, the warehouse uses this copy to ensure the right model is packed and scheduled for delivery on the correct date. 3. Copy 3. Kept in sales department, handling customer inquiries. Purpose: this copy stays with the sales team, helping them address any questions or concerns the customer may have about the order. Example: suppose the customer calls to check on the delivery status. The sales team refers to this copy to answer questions about delivery timing or order details. 4. Copy 4. Sent to accounts, generating the invoice. Purpose: this copy goes to the accounts department, who will use it to create an invoice for the customer. Example: when the order is shipped, accounts can refer to this copy to prepare and send the invoice to the customer for payment. 5. Copy 5. Sent with goods, as an advice note for the customer. Purpose: this copy is attached to the goods, providing the customer with a summary of the order for their records. Example: when the heating system arrives, the customer receives this copy to confirm that everything matches what they ordered. 6. Copy 6. Sent with goods as a delivery note, signed by customer. Purpose: another copy goes with the goods as a delivery note, which the customer signs to acknowledge receipt. The seller keeps this signed copy as proof of delivery. Example: the delivery person presents this copy to the customer, who signs it to confirm they received the heating system. The signed copy is then kept by the seller. 7. Copy 7. Kept in warehouse, handling customer queries. Purpose: the warehouse keeps an additional copy to help answer any questions or handle issues related to the shipment. Example: if the customer reports that they received the wrong item or something was damaged, the warehouse can refer to this copy to double-check the order and manage purchase order sets. Just like sales orders, purchase order sets also come in multiple copies to help the buyer keep track of what they ordered. Each copy has a specific purpose to ensure that the purchasing, receiving, and accounting departments are all on the same page. Purchase order copy locations and purposes. 1. Copy 1. Sent to the supplier, placing or confirming the order. Purpose: this copy goes to the supplier to formally place the order or confirm a previous order made by phone or email. Example: suppose ABC Heating Solutions needs heating system parts from XYZ Supplies. They send this copy to XYZ as an official order for the required parts. 2. Copy 2. Kept in purchasing department or warehouse. Purpose: this copy stays in the buyer's purchasing or warehouse department for easy reference. It's used to compare with the supplier's delivery and advice notes to make sure everything matches. Example: when the parts arrive from XYZ Supplies, the warehouse team checks the items against this copy to ensure they received the correct products and quantities. 3. Copy 3. Sent to accounts for matching invoices and goods received. Purpose: this copy goes to the accounts department, where it's used to verify the supplier's invoice and make sure the items have been received as ordered. Example: once the goods are received, the accounts team matches this copy with the invoice from XYZ Supplies to make sure they're only paying for items that were delivered. Using sales order sets and purchase order sets in this structured way helps companies manage orders efficiently. It provides everyone involved with the right information to fulfill orders accurately, handle customer queries, and maintain clear records for invoicing and payments. An invoice is a document issued by a seller to a buyer requesting payment for goods or services provided. In essence, it serves as a formal demand for payment. Invoices are created whenever a transaction takes place where payment is due, whether immediately or within a specified time. What is considered a sale for one business is viewed as a purchase for the buyer, meaning both sides have different records but for the same transaction. An invoice typically includes detailed information about the items sold or services rendered, the agreed upon prices, any additional charges or taxes, and the total amount the buyer needs to pay. Key details. Usually found on an invoice. An invoice generally contains the following important details. 1. Seller's information. This includes the seller's business name, address, and contact details. For example, in our sample, Chippy's is the seller with its address and contact number clearly stated. 2. Buyer's information. The invoice also lists the buyer's name and address. In our example, Tabletops is the buyer, with their address provided to ensure clarity. 3. Invoice number. This is a unique identifier for each invoice. Every invoice has a different number to help the business keep track of all the invoices it sends out. For example, the invoice number is 13456, which makes it easy for both the buyer and seller to reference this specific transaction. 4. Date of issue. The invoice date shows when the invoice was created. This is important for tracking due dates and understanding when the transaction occurred. 5. Tax point time of supply. This is often the same as the invoice date and indicates when the sale took place for tax purposes. 6. Description of goods or services. The invoice details what items were sold or services were provided. For example, tables is specified on the invoice, so the buyer knows exactly what they're being charged for. 7. Quantity and unit price. The invoice shows how many units of each item were sold and the cost per unit. In the example, 30 tables were sold at $250 each. 8. Total amount. This includes the total price for the goods or services, along with any delivery charges or additional fees. 9. Sales tax information. If sales tax is applicable, the invoice will show the tax rate and the calculated tax amount, helping the buyer see how the total payment is derived. 10. Payment details. Instructions on how to pay, including any bank account details, are often included to make the payment process easier. Types or uses of invoices. Invoices can be used in different ways depending on when and how payment is required. Let's go through the main types of invoices to better understand their different uses. 1. Cash invoice, or receipt, when it's used. A cash invoice, often just called a receipt, is used when a transaction is settled immediately in cash. Example, suppose a manager pays cash for a business meal at a restaurant. The restaurant will provide a receipt as evidence of the expense. The receipt may include a note like, "Paid with thanks," indicating that payment was made in full at the time of the transaction. Purpose, it serves as proof that the payment was made right away, so there is no outstanding balance. Cash invoices are typically short and straightforward, as payment is already completed. 2. Cash on delivery, COD invoice. When it's used. A code invoice is used when the buyer is expected to pay upon receiving the goods. Example, a company purchases a new car and agrees to pay for it on delivery. The car dealership sends a COD invoice, and the payment is collected when the car is delivered. Purpose. This type of invoice ensures the seller receives payment at the time of delivery, reducing the risk of non-payment. It's often used in situations where the buyer and seller may not have an established credit relationship. 3. Credit invoice. When it's used. A credit invoice is used in transactions where goods are delivered, but the buyer is allowed to pay later, often within an agreed period, e.g. 30 days. Example, suppose a business receives a delivery of raw materials from a long-standing supplier. The supplier trusts the buyer and allows them to pay within 30 days. A credit invoice is issued to document the sale and the payment terms. Purpose. This type of invoice provides a record of the transaction and specifies when the buyer should make the payment. Credit invoices are common in business-to-business transactions where there is a credit agreement between the buyer and seller. Understanding invoices as receipts or credit documents. It's helpful to understand that while invoice often refers to a credit transaction where payment is due later, the term can also apply to immediate cash transactions. Therefore, invoices are not exclusively associated with credit. They may need to be settled right away, cash transactions, or after a period, credit transactions. Why is an invoice important? An invoice is more than just a request for payment. It's an essential document in business for the following reasons. 1. Record keeping. It provides both the buyer and seller with a record of the transaction, which helps in financial tracking and accounting. 2. Legal document. Invoices can serve as legal documents in case of disputes, as they confirm the agreement between the buyer and seller regarding payment terms, items sold, and total amount owed. 3. Tracking payments. With unique invoice numbers, businesses can easily track which invoices have been paid and which are still outstanding. 4. Tax purposes. Invoices document sales and taxes collected, making it easier for businesses to report accurately on tax returns. 5. Customer relations. Clear and detailed invoices reduce misunderstandings and provide customers with confidence as they know exactly what they're being billed for. By understanding the components and uses of an invoice, both buyers and sellers can handle transactions smoothly, maintain clear records, and ensure that payments are made accurately and on time. Let's break down and describe this sample invoice from Chippy's in detail. Here's what each part of the invoice means so it's easier to understand. 1. Header information. Seller details. The seller's business name is Chippy's. Their address is Woodhouse, Richmonds Road, London, SE1N 5AB. This information is important because it identifies who the buyer, in this case Tabletops, is dealing with and who is demanding payment. Invoice number. The invoice number here is 123456. This is a unique identifier for this specific invoice, making it easier for both the buyer and seller to track the transaction. Date. The date on the invoice is 0108X7. This represents the date the invoice was issued, which is important for record keeping and tracking when payment is due. Tax point. The tax point, or time of supply, is also dated 108X7. This indicates the date the transaction occurred for tax purposes, which is crucial for calculating when sales tax applies. Account number. This is the seller's reference account number, 3365, which may be used internally by Chippy's for customer account tracking. 2. Buyer and delivery information. Invoice 2. The buyer's details are labeled as Tabletops, located at 2 Peters Square, Wayford, Kent, CR2 2IA. This section identifies who is responsible for paying the invoice. Deliver to. Interestingly, this section also states same address, meaning that the delivery address for the goods is the same as the buyer's address. Sometimes businesses may have a different delivery address, but here, both are the same. 3. Contact and tax details. Telephone number. Chippy's contact number is 0171-123-4567, which buyers can use if they have questions regarding the invoice. Sales tax registration number. This number, 457-463519, is Chippy's tax registration identifier. It shows that Chippy's is registered to collect sales tax, and this registration number must be on invoices to comply with tax regulations. Bank details. The Northern Bank Code 20-2542 and account number 957023 are provided in case the buyer prefers to pay directly through the bank. This is common in business transactions as it simplifies the payment process. 4. Main body of the invoice. Order reference number. Your order number, 2490, helps Tabletops match this invoice with their original order, making it easier to track what they ordered. Item code. Each item has a unique code for identification. Here, 13579A refers to the tables that Tabletops ordered. This code allows the seller and buyer to refer to specific products more accurately. Description. A short description, tables, shows what is being purchased. Additional details can be included in this section, but tables is sufficient here as it matches the order. Quantity. The quantity ordered is 30 tables. This section shows how many units of the item the buyer requested. Unit price. The price per table is $250. Unit price is crucial because it helps in calculating the total cost based on quantity. Net amount. The total cost for 30 tables is calculated as $250 by 30, which equals $7,500. There's also a delivery charge of $100, making the total net amount for goods and delivery $7,600. 5. Invoice total summary. Sales value. The sales value of $7,600 represents the subtotal before sales tax is added. Sales tax. The sales tax rate is 17.5%. This sales tax is added to the subtotal, showing compliance with tax requirements. Amount payable. The total amount payable is the sum of the sales value and sales tax. $7,600 plus $1,330 equals $8,930. This is the final amount that Tabletops needs to pay to Chippies. 6. Understanding the importance of each section. Why use an invoice? An invoice is a formal request for payment from the seller to the buyer, documenting the items sold, their quantities, prices, and any additional charges or taxes. It serves as a legal document that the buyer owes this amount to the seller. Tracking with invoice number. The invoice number helps both the buyer and seller keep track of payments and identify specific transactions in their records. By breaking down the invoice, it becomes easier to see each element's role and understand how it helps both the buyer and seller keep records, track payments, and ensure all sales and purchases are documented accurately. Additional information, often found on invoices. Invoices can contain a variety of terms and phrases that clarify specific details about the payment, delivery, and other important aspects of the transaction. Here, we will break down some common terms and phrases found on invoices, explaining what they mean and providing examples to make them easier to understand. 1. Payment due date and terms of sale. The payment due date is the final day by which the buyer is expected to complete payment. Terms of sale refer to conditions set by the seller regarding when and how payment should be made. Example of net 30 days. The term net 30 days is often found on invoices to mean that payment is due within 30 days of the invoice date or delivery date, depending on the agreement. Imagine that Chippies Furniture Co. issues an invoice to Tabletops Ltd. on March 1st with the term net 30. This means that Tabletops Ltd. has until March 31st to pay the full amount due on the invoice. If payment is not made by that date, it might incur late fees or penalties as stipulated by Chippies Furniture Co. Other common terms. Net 15 days would mean payment is due 15 days after the invoice date. Due on receipt means that payment is expected immediately upon receiving the invoice. 2. Free on board. FIA stands for free on board, which refers to a shipping term often used in international trade. It tells both the buyer and seller who is responsible for paying transportation costs and when the risk for the goods transfers from the seller to the buyer. It can be broken down into two types. FOB shipping point, meaning in an FOB shipping point arrangement, the seller is responsible for all costs and risks until the goods reach the shipping point, like a port or warehouse. Once they reach this point, the buyer assumes responsibility for all transportation and delivery costs. Example, let's say Chippies Furniture Co. is shipping tables to Tabletops Ltd. with the term FOB shipping point. Chippies Furniture Co. will cover the costs of bringing the tables to the shipping port. But once the tables are at the port, Tabletops Ltd. will be responsible for all costs of transportation from that point, including shipping fees, insurance, and any other charges. Meaning, with FOB destination, the seller is responsible for all shipping costs and risks until the goods reach the buyer's location. Example, if the invoice says FOB destination, then Chippies Furniture Co. will bear all costs to deliver the tables directly to Tabletops Ltd. This is common in scenarios where the seller has arranged full delivery to ensure the buyer receives the goods intact. 3. Tax point for sales tax point is the date at which sales tax becomes applicable to a transaction. It is used to determine when a sale is subject to tax and at what rate, based on the applicable tax rate on that specific date. Example. Suppose Tabletops Ltd. buys tables from Chippy's Furniture Co. on March 1st. The sales tax rate is applied based on the tax point, March 1st in this case. If the tax rate was adjusted later, that change wouldn't affect this sale, as the tax is calculated based on the date the transaction took place. 4. Ex works. The term ex works refers to a situation where the seller makes the goods available at their premises, and the buyer is responsible for all transportation costs from that point onward. This term is frequently used in international trade, indicating that the buyer must arrange for and pay all shipping and delivery expenses. Example. If the invoice from Chippy's Furniture Co. to Tabletops Ltd. includes ex works terms, it means that Tabletops Ltd. would need to pick up the tables from Chippy's warehouse. From that point on, all expenses related to moving the tables, such as shipping fees, insurance, and handling costs, would be the buyer's responsibility. 5. E&OE, errors and E, errors and omissions accepted. The phrase stands for errors and omissions accepted. It is a disclaimer that allows the seller to correct any mistakes or omissions on the invoice after it has been issued, should they notice a discrepancy. Example. Suppose Chippy's Furniture Co. accidentally lists the total amount on Tabletops Ltd.'s invoice as $8,000 instead of $8,200. The E&OE phrase would allow Chippy's Furniture Co. to correct this mistake even after the invoice has been sent to Tabletops Ltd. However, it's generally considered best practice for sellers to double-check invoices before issuing them, as frequent use of E&OE could damage trust between the parties. What is a credit note? A credit note is a document issued by a seller to reduce the amount a customer owes on a previously issued invoice. It acts as a way for the seller to adjust the outstanding amount, which can happen for various reasons, such as 1. Quality issues. The goods delivered might be damaged, defective, or not up to the expected quality. 2. Errors on the invoice. The original invoice may contain errors, like incorrect prices or quantities. 3. Partial return of goods. The customer might return part of the goods while keeping the rest. When a credit note is issued, it works like a negative invoice. Instead of creating a new invoice, the seller reduces the original invoice's total, and the buyer now owes only the adjusted amount. This allows both parties to keep a clear and organized record of their transactions without having to delete or replace the original invoice. How does a credit note work? A credit note is directly linked to the original invoice. When a seller issues a credit note, it reduces the total amount the buyer has to pay. For example, if the buyer originally owed $500 and the seller issues a credit note for $100, then the buyer will only need to pay $400. The credit note helps to keep everything in balance by adjusting the buyer's outstanding amount on the original invoice. When the payment is made, the buyer will only pay the net amount, the original invoice amount minus the credit note amount. Example, Paperchase Supplies and Tabletops Ltd. To understand how a credit note works, let's look at an example where Paperchase Supplies issues an invoice and later a credit note to their customer, Tabletops Ltd. The original invoice. On March 25, 2007, Paperchase Supplies issued an invoice. Invoice number 123678 to Tabletops Ltd. for office supplies. Here are the main details of this invoice. Goods, 200 units of a product called ring binders, identified with the code X12345Y. Unit price, each ring binder is priced at $2. Total goods cost, the total cost for the goods is $400. 200 units multiplied by $2 each. In addition, there is a sales tax, V8, applied at 17.5%, which amounts to $70 on the goods. Therefore, the total amount payable on the invoice is calculated as follows. Total goods cost, $400. Sales tax, $70. Total amount to pay, $400 plus $70 equals $470. This invoice serves as a request for Tabletops Ltd. To pay $470 for the items purchased. Issuing the credit note. After receiving the goods, Tabletops Ltd. raised a concern with Paperchase Supplies. Perhaps some of the ring binders were not satisfactory, or there was an error in the order. As a response, Paperchase Supplies issued a credit note on April 6, 20X7 to adjust the amount Tabletops Ltd. needs to pay. The credit note number 245, contains the following details. Goods returned. Table returned 50 units of the ring binders. Unit price. The unit price remains the same at $2 per ring binder. Amount credited for goods. Since 50 units were returned at a unit price of $2, the total credited amount for the goods is $100. 50 units multiplied by $2 each. Sales tax. The credit note also adjusts the sales tax. At a rate of 17.5%, the VAT on the credited amount of $100 is $17.50. Thus, the total credit amount on the credit note is calculated as follows. Credit for returned goods, $100. VAT credit, $17.50. Total credit amount, $100 plus $17.50 equals $117.50. By issuing this credit note for $117.50, Paperchase Supplies reduces the total amount that Tabletops Ltd. has to pay on the original invoice. Calculating the new payment amount. Now, when Tabletops Ltd. prepares to make the payment to Paperchase Supplies, they will adjust the original invoice amount by subtracting the credit note amount. Here's the breakdown. Original invoice amount, $470. Less credit note amount, minus $117.50. Adjusted amount to pay, $470 minus $117.50 equals $352.50. Therefore, Tabletops Ltd. now needs to pay $352.50 after accounting for the credit note. Recording the payment. When Tabletops Ltd. finally makes the payment, they should ensure that they properly document this transaction to reflect both the original invoice and the credit note. On April 24th, 20X7, when they send the payment, they can follow these steps. 1. Record the invoice and credit note numbers. On the payment documentation, such as the check counterfoil or a payment record, they should note the invoice number 123678 and the credit note number 2045. This ensures that both documents are clearly referenced. 2. Stamp the invoice paid with the date April 24th, 20X7, indicating that payment has been made. 3. Stamp the credit note claimed with the same date, showing that the credit was used as part of the payment. By following these steps, both Tabletops Ltd. and Paperchase Supplies can keep a clear, accurate record of the transaction adjustments. Importance of credit notes. Credit notes are essential for maintaining accurate and transparent financial records. They allow sellers and buyers to adjust invoices without needing to delete or replace the original records. For buyers, credit notes help to track any deductions or adjustments in payment amounts, which is especially useful when there are returns, quality issues, or other adjustments needed. Debit note definition and purpose. A debit note is an official document issued to request or record an adjustment to a previously issued invoice. It's used in business transactions when there's a need to adjust the amount payable due to errors, overcharges, or returns. It acts as a formal request for a credit note from the other party, particularly when the original invoice amount needs to be corrected downward. When and why a debit note is issued. A debit note is issued in various scenarios. Each situation addresses a specific issue with the initial transaction, helping to keep both parties' accounts accurate and organized. Here are the main scenarios. 1. Debit note issued by the customer. In most cases, a debit note is issued by the customer to the supplier when the customer believes that the original invoice is incorrect. Common reasons for issuing a debit note from the customer's side include faulty or damaged goods. When goods are received but found to be defective, damaged, or not in the condition expected, the customer may request a reduction in the payment amount. This can happen, for example, if certain items are scratched, broken, or not functioning properly. Incorrect quantity delivered. If the supplier delivers fewer items than ordered but charges for the full quantity, the customer can issue a debit note to adjust the amount due. This document formally requests a reduction to match the quantity that was actually received. Errors in pricing. Sometimes, the supplier may mistakenly overcharge on an invoice. The customer might notice that a higher price was applied than agreed upon. In this case, the customer issues a debit note to request a correction in the price, ensuring that they pay the agreed amount only. Example scenario. Imagine that Company A orders 100 units of a particular product from supplier B. When the goods arrive, Company A finds that 10 units are damaged and therefore not usable. Instead of paying for the full 100 units, Company A issues a debit note to supplier B, specifying the need to reduce the total amount by the value of those 10 damaged units. The debit note thus serves as an official record, explaining why Company A will not pay the full amount, and it's a request for a credit adjustment from the supplier. 2. Debit note issued by the supplier. In certain situations, the supplier might issue a debit note to the customer. This typically happens when the supplier realizes that they undercharged the customer in the initial invoice. Reasons for a supplier to issue a debit note include undercharging on the original invoice. If there was an error in the initial invoice where the amount charged was lower than it should have been, the supplier might issue a debit note to adjust the amount payable upward. Additional services or goods provided. If the supplier provides extra services or additional goods that were not accounted for in the original invoice, they might issue a debit note to cover the extra cost. Example scenario. Let's say supplier B initially billed Company A for $500, but later realizes that the correct amount should have been $550 due to an oversight in pricing. Supplier B can issue a debit note for the additional $50, formally notifying Company A of the adjustment. This debit note explains the reason for the increase and updates the record for the final amount payable. Key components of a debit note. A debit note should be clear and detailed to avoid any misunderstandings. The typical elements in a debit note include debit note number, a unique reference number that helps both the sender and receiver track and organize the document for future reference. Date of issue, the date when the debit note was created, establishing when the adjustment was requested. Original invoice number, a reference to the original invoice that the debit note relates to, ensuring both parties can match the debit note with the initial billing document. Description of goods or services, details of the items or services in question, especially if they're being returned, found faulty, or if the quantity or price needs adjustment. Adjustment amount, the specific amount that the customer or supplier is adjusting, either adding to or deducting from the original amount. This ensures both parties are on the same page regarding the total value being disputed or corrected. Reason for adjustment, a clear and concise explanation of why the adjustment is being requested or issued. For example, 10 units returned due to defects, or correction in unit price due to billing error. Importance and role of debit notes in business. Ensuring accurate financial records. Debit notes help both buyers and sellers maintain accurate financial records. They serve as an official document to clarify adjustments, making sure both parties have the same understanding of the transaction details. Formal documentation for discrepancies. When there's an issue with an invoice, such as damaged goods or incorrect charges, a debit note provides formal documentation of the discrepancy. This can be crucial for avoiding disputes later, as it provides a clear record of what was requested and why. Enabling proper inventory and payment tracking. For companies managing large quantities of goods, Debit Notes assist with inventory control by tracking returns and discrepancies. The accounts team also relies on Debit Notes to verify the correct amount payable, preventing overpayment or underpayment. Facilitating communication between buyer and seller. Debit Notes make it easier to communicate necessary adjustments formally. Both the buyer and the seller have an official document outlining the changes, making it less likely for miscommunication to occur regarding the payment amount or the reason for adjustments. In summary, a debit note is a vital tool in business transactions, providing a structured way to handle errors, returns, and adjustments in invoicing. It keeps financial records accurate, prevents misunderstandings, and fosters smooth communication between buyers and sellers, ensuring that each party is clear on the final terms of payment. Goods Received Note, GRN. Definition and purpose. A goods received note is an official document created by a company's warehouse or receiving department to confirm that goods ordered from a supplier have been received. It's an essential document in the purchasing and inventory management process as it helps to maintain accurate records of the quantities and condition of items received. The GRN acts as an internal record, confirming that the goods listed on the purchase order have arrived. It also allows the accounts department to match the goods received with the supplier's invoice before processing payment. When and why a goods received note is issued. A GRN is issued whenever goods are received from a supplier. It serves several important functions in the purchase and inventory process, including verification of goods. The GRN confirms that the quantity and quality of the goods received match what was ordered. It helps prevent mistakes by providing an official check against the purchase order. Inventory management. The GRN is used to update inventory records as it provides a record of goods that have been added to stock. This helps keep an accurate count of available products. Payment authorization. Before the accounts department pays the supplier, they need to confirm that the goods were indeed received as expected. The GRN acts as proof of receipt and allows the accounts team to cross-check the supplier's invoice with what was actually received. Internal communication. The GRN is also an internal document that helps departments within a company communicate. It informs the purchasing and accounts teams that the order has been received, preventing miscommunication between departments. Example scenario. Let's imagine that ABC Company orders 50 cartons of printer paper from a supplier. When the order arrives at ABC's warehouse, the receiving department checks each carton to ensure that all 50 have arrived and are in good condition. The receiving team then fills out a GRN, documenting the date, quantity, and condition of the goods, which is then shared with the accounts department. When the supplier's invoice is sent over for payment, the accounts team can use the GRN to confirm that everything ordered has indeed been received. Key components of a goods received. Note, a GRN typically includes detailed information to ensure clarity and accuracy. Key elements in a GRN number. A unique reference number that helps track the GRN in company records. Date of receipt, the date on which the goods were received. This helps in maintaining an accurate timeline for inventory records and payment processing. Supplier details. Information about the supplier, including their name and contact information, which helps identify the source of the goods. Purchase order reference. The GRN usually refers to the original purchase order, PO number, allowing the receiving department and accounts team to easily match the GRN with the correct order. Description of goods. A detailed list of the items received, including product codes, names, and descriptions. This ensures that everyone reviewing the GRN can clearly understand what was received. Quantity received. The quantity of each item received, which is compared against both the purchase order and the supplier's invoice. If there is a discrepancy, such as fewer items received than ordered, this is recorded on the GRN. Condition of goods Any issues with the condition of the goods, such as damages or defects, are noted here. This is important for quality control, as damaged items may need to be returned or replaced. Signature of receiver. The person who inspected and received the goods typically signs the GRN. This adds accountability, confirming that the person responsible has verified the details on the document. Importance and role of a goods received note in business. 1. Prevents payment errors. The GRN acts as a safeguard for the accounts department, helping them verify that payment is only made for goods actually received. By comparing the GRN with the purchase order and supplier's invoice, companies avoid paying for items that may have been invoiced but not delivered. 2. Ensures inventory accuracy. The GRN is a crucial document for keeping inventory records up to date. When goods are added to stock, the GRN is used to adjust inventory levels, which helps prevent stockouts and overstocking. 3. Facilitates internal audits and accountability. The GRN creates a clear paper trail from the purchase order to the receipt of goods, making it easier to audit purchasing processes. It also adds accountability, since it requires a signature from the person who checked the goods. 4. Helps manage supplier relationships. GRNs play a role in managing relationships with suppliers. If there are frequent issues, such as incorrect quantities or damaged goods, the GRN serves as documented proof of the problem, allowing the purchasing department to negotiate better terms or request replacements from the supplier. 5. Documentation for discrepancies. If there is a discrepancy in quantity or condition of goods, the GRN documents the problem. This is useful for addressing issues with the supplier, such as requesting a replacement or adjusting the invoice. 6. Supports accurate financial reporting. By ensuring that only received goods are recorded in inventory and paid for, GRNs contribute to accurate financial reporting. They prevent overstating expenses in inventory, helping companies maintain realistic financial records. In summary, a goods received note, GRN, is an essential document in the purchasing process that records the receipt of goods, ensuring accurate inventory, supporting payment verification, and fostering smooth communication across departments. It helps keep financial and inventory records accurate, providing both verification and accountability. E-commerce, transforming how we buy and sell goods globally. What is e-commerce? E-commerce, or electronic commerce, is the buying and selling of goods or services over the internet. It has revolutionized traditional shopping by allowing transactions to take place entirely online, removing the need for face-to-face interactions or physical paperwork. With just a few clicks, you can now purchase anything from books and clothes to electronics and groceries, right from the comfort of your home. The most significant benefit of e-commerce is its ability to connect buyers and sellers worldwide, enabling global trade on a scale that was once unimaginable. E-commerce and global access. One of the most exciting aspects of e-commerce is how it allows people to buy products from virtually any part of the world. For example, if you're living in Australia, you can easily buy a book published in the United Kingdom or the United States without ever setting foot outside your home. Just go to the website of an international retailer, choose the book, pay online, and it will be shipped right to your doorstep. This level of convenience and access was almost impossible before e-commerce. With e-commerce, geography is no longer a barrier. Whether it's a rare item, a limited edition product, or just something that's not available locally, e-commerce makes it easy to purchase products globally. This accessibility has significantly increased choices for consumers and has allowed small and large businesses alike to reach customers far beyond their local markets. How e-commerce streamlines documentation and processes. E-commerce has simplified not only the shopping experience, but also the documentation process for transactions. Traditionally, making a purchase involved multiple steps and a series of paper documents, like purchase orders, invoices, delivery notes, and payment receipts. In e-commerce, these steps are either fully automated or replaced by digital equivalents. Here's how e-commerce has streamlined various parts of the buying process. 1. Instant transactions and payments. With e-commerce, the entire transaction happens instantly. As soon as you make a purchase, payment can be completed through online methods like credit or debit cards, digital wallets such as PayPal or Google Pay, or bank transfers. This eliminates the traditional delay of waiting for an invoice, sending a check, or arranging other types of offline payments. 2. Digital invoices and receipts. Instead of receiving a paper invoice, customers receive a digital receipt or e-invoice immediately after completing their purchase. This electronic document includes all necessary details like item description, price, taxes, and payment confirmation. This e-invoice is instantly recorded in the seller's system, which reduces the need for physical storage and simplifies record keeping. 3. Order confirmations and tracking. After the transaction is complete, an order confirmation email is usually sent. This confirmation acts as proof of purchase and includes all the information about the order. Once the item is shipped, e-commerce platforms provide tracking information so customers can monitor their delivery status online. This is especially helpful for international purchases, as customers can see the item's journey across borders in real time. For automatic record keeping, e-commerce platforms automatically store each transaction in a digital ledger. This allows both customers and sellers to easily access past purchase records without sorting through paper files. For businesses, this digital storage makes it simple to manage inventory, analyze sales trends, and handle customer inquiries efficiently. 5. Reduced need for delivery notes and physical receipts. Traditional sales often require delivery notes to confirm that items had arrived. In e-commerce, delivery confirmations are sent digitally. For example, customers might receive an email or SMS notification that their item has been delivered. Some couriers even offer electronic proof of delivery through GPS tracking or digital signatures. This makes it easy to verify deliveries without relying on physical paperwork. Example: buying a book from an international seller. Imagine you're a student in India and you need a specific textbook that's only available in the UK. Here's how e-commerce makes it simple. You find the book on a UK-based retailer's website, add it to your cart, and complete the checkout by entering your shipping details. You pay for the book online using a credit card or digital payment option. Immediately after payment, you receive a confirmation email with details of your order and an estimated delivery date. Once the book is shipped, the retailer sends you a tracking link, allowing you to see where your package is in real time, even as it travels across international borders. Within a few days or weeks, depending on the shipping speed, the book arrives at your doorstep. This entire process, finding the item, ordering it, paying, and tracking it, takes just minutes and requires no physical paperwork. E-commerce has made it as easy to buy something from another country as it is to shop at a local store. Benefits of e-commerce documentation for businesses and customers: time and cost efficiency. E-commerce eliminates the need for paper-based documentation, which saves both time and money. Businesses no longer need to print, store, or physically organize documents. 2. Improved accuracy. With automated systems, there is less room for human error in recording transactions. Every detail, such as price, item description, and payment information, is recorded digitally, ensuring accuracy and reducing the chances of mistakes. 3. Instant access to transaction records. Both customers and businesses can easily access digital records at any time. Customers can quickly retrieve purchase details or request returns, while businesses can track orders and manage inventory seamlessly. 4. Environmentally friendly. By reducing the need for paper, e-commerce contributes to environmental sustainability. The switch to digital documentation means fewer trees are cut down, and there's less waste from printed documents. 5. Enhanced customer experience. E-commerce platforms often provide features like instant refunds, easy return processes, and detailed FAQs, which improve the shopping experience. Digital documentation simplifies customer service and allows for faster, more efficient support. In summary, e-commerce has fundamentally changed the way we shop. making it possible for people to access goods from anywhere in the world with just a few clicks. By replacing traditional documentation with digital processes, e-commerce allows for faster transactions, greater accuracy, and a more streamlined experience. Whether buying a book from another country or ordering local groceries, e-commerce has made the entire process of purchasing, paying, and tracking orders easier, faster, and more accessible than ever before. This global reach and simplified documentation have transformed not just retail, but the entire landscape of buying and selling.